Oliver Brown, lead manager of the MFM UK Primary Opportunities Fund, is with us today to discuss the day after tomorrow. Oliver, good morning.
Good morning, Mary.
How have you navigated the fund through the pandemic? Not to forget, of course, Brexit.
We will always hold a well-diversified portfolio across different sectors, market capitalizations, typically 60 to 80 stocks in the portfolio. So no matter what is going on in the world, we've got a well-diversified portfolio that should have an ability to hold up as best as possible, no matter what the market conditions are. Throughout 2020, we stuck very, very closely to sort of large cap, defensive companies whose products are going to be in demand, whatever the market conditions. I'm talking about companies like AstraZeneca, which of course has been very much in the news with the development of the vaccine. Unilever, whose products, are sold globally, and basics that people will always need and want to buy. We also saw the opportunity to actually buy into some really, really good quality companies that don't often raise money. Companies such as ASOS, the online retailer, that was seeing its sales, increase dramatically as a result of lockdowns, but also the opportunity to buy into companies that we perceive as being very high quality businesses, but were suffering in the short term as a result of the pandemic and their businesses shutting down in many cases. So the likes of JD Wetherspoons, the largest pub operator, the Gym Group, a low-cost gym operator, WH Smith, which is really growing its concessions in airports and railway stations. So we saw a real opportunity there to buy into very high quality stocks that wouldn't normally have the need to raise money, but because of the very specific conditions that the pandemic brought, were having to raise money to help shore up their balance sheet. And we saw this as a wonderful opportunity to buy into some really good quality companies, and as a result, make our portfolio that we always see as high quality, even higher quality. So we're very excited by the makeup of our portfolio right now.
Importantly for investors, how do you see 2021 panning out?
With the fog of Brexit now being lifted, deal has been done with the EU, so that uncertainty about our future trading relationship has now been, put to bed. We expect to see a lot of money raised. We saw 2020, we saw a very busy year there for fundraisers, and over £25 billion was raised by UK listed companies. I have to say 2021 is looking, if not even busier. So we are seeing the IPO market, which has been pretty quiet. We did invest in a few IPOs in 2020, which have done very, very well. But 2021 is looking like a very, very busy year for companies coming to the market. Doc Martens, the well known for its shoes and its boots. Moonpig, which is an online card retailer. Foresight Investment Management, which is an investment manager focused on alternatives, alternative investments and infrastructure funds. And those are just a few that have actually, said that they're intending to float. I've got a list of other companies that are being mooted to float, other companies that I'm expecting to come to the market, that I've even spoken to, or I'm aware from conversations with the investment banks. And on top of that, we've got the bread and butter of companies that are already listed that are going to be wanting to expand, because we expect to see 2021, an economic rebound. Once we get through this latest lockdown and the vaccines start to take effect, we should see a real material rebound in economic conditions, and companies are going to need funding in order to expand.
Your top 10 actives look very different from your top 10 positions. Can you walk our audience through these stocks and why you hold them?
My top 10 holdings are typically the larger FTSE companies, dividend payers. On the whole, pretty stable. They provide important ballast, if you like, to the portfolio. And it was many of them that actually, held up, well, when the markets were falling very, very sharply, last February and March. Because of their size, we believe they're good quality and they provide, useful income. And typically they are less volatile than the average stock. But our top 10 actives are all companies that we've bought more recently through our primary markets approach. Some of them have done very well, which is why they're quite large. They're larger positions, and they're companies that we've got high conviction with.
Oliver, what qualities do you look for in investee companies, and what do you look to avoid?
So we like to invest in good quality companies, and what we mean by that, companies that are market leaders in their sector or have got a particular niche in their sector, which allows them to protect their market share, grow their margins, or of course protect their margins as well. We like companies with good management teams who have got a history of under-promising and over-delivering. In terms of companies we look to avoid, perhaps companies where we don't see any of those things that we've just mentioned in terms of market leadership or a particular niche. So perhaps we just see that there's nothing particularly special about the company, might be perfectly worthy, but nothing that really can get us excited. Companies that are hard to value, so that might be very, very early stage companies where we just don't understand the size of the market perhaps, and therefore don't have enough confidence, or it's just too early stage for us, and something that we could revisit at a later stage if they start to prove and put their plans into place. And also companies that are in markets that are structurally declining, we've looked to avoid. So, an obvious example at the moment is, high street retailers. That's not an area that we would naturally be looking to invest in, because clearly the move is all towards online. That's where the growth is. So that's where our focus would be on in investing.